What if I told you that the biggest danger in the financial system today is not what you can see, but what you cannot see? Most people think the risk is inflation, stock market crashes, or government debt. But the real issue is liquidity. Liquidity means the ability to buy and sell something easily without moving the price too much. It sounds simple, it sounds safe. But what if that liquidity is just an illusion? What if the system looks strong on the outside, but underneath it is built on layers of debt, leverage, and contracts that cannot be converted into anything real? Welcome to Gold Silver Scope. Today, we need to understand how the financial system is structured. Imagine a pyramid. At the very bottom of that pyramid sits physical gold and physical silver. These are real assets. They have no counterparty risk. They are not someone else's promise. Above them sits physical cash currency. Above that sit bank deposits. Above that sit bonds, stocks, and funds. And at the very top of the pyramid, the largest layer of all, sit derivatives. These derivatives are not real assets. They are contracts. They are leveraged bets on price movements, interest rates, currencies, and commodities. Here is where the danger begins. On a global basis, the reported notional value of derivatives is around $714 trillion. That number alone is massive. It is many times larger than global GDP. But here is the trick. That number is netted. That means financial institutions use accounting methods to offset contracts against each other, making the total exposure look smaller. Reports suggest netting benefits can reduce reported exposure by around 80% or more. But that does not remove the actual risk. It only hides it on paper. When you reverse engineer those numbers, the real gross exposure behind the system can run into the quadrillions. Even if we do not use the most extreme estimates, it is clear that derivatives are multiple times larger than the real economy. And here is the key point. You cannot convert a derivative into the underlying physical asset in most cases. It is a contract that settles in cash. It is a promise. And promises depend on trust and stability. Originally, derivatives had a purpose. A farmer planting crops in January and harvesting in September might sell futures contracts to lock in a price. That way, if prices collapse, he still survives. That is hedging. That is responsible use. But today, most derivatives are not used for hedging real goods. They are used for speculation. Financial institutions create contracts based on interest rates, currencies, metals, indexes, and even volatility itself. These are layered on top of each other. They multiply exposure without creating real value. This is why liquidity becomes an illusion. As long as markets are calm, everything works. Buyers and sellers match. Contracts roll over. Prices adjust slowly. But when volatility increases, liquidity disappears. Suddenly, everyone wants to exit at the same time. But there are not enough real buyers. There is not enough real cash. And there is definitely not enough physical gold or silver to back the paper claims. Now, let us connect this to debt. Governments around the world are drowning in debt. Headlines say debt is approaching crisis levels. The truth is, in many countries, the crisis level has already been reached. The system survives because central banks continue to create new money. This money printing makes debt look manageable in the short term, but it reduces purchasing power over time. If you look at long-term purchasing power charts published by central banks themselves, you will see that fiat currencies lose value steadily. At the moment you receive your salary, your money has the highest purchasing power it will ever have. From that moment forward, inflation slowly eats it away. Over decades, the loss becomes dramatic. Many historical currencies have eventually reached zero purchasing power. Now think about this carefully. All stocks, bonds, retirement accounts, and bank deposits are denominated in fiat currency. If the currency itself is losing value, then the assets priced in that currency are built on a weakening foundation. That is why gold and silver matter. They are not someone else's liability. They do not depend on a bank's balance sheet. They do not depend on a derivative counterparty honoring a contract. The entire financial pyramid sits on a very small base of real, tangible assets. Physical gold and physical silver represent a tiny fraction of global financial assets. If even a small percentage of capital tries to move from paper assets into physical metal during a crisis, the price impact could be extreme. Not because gold changes, but because the currency used to price, it loses credibility. This is why understanding liquidity and derivatives is critical. The system works until it does not. And when confidence breaks, the shift can be fast. In the next part, we will go deeper into gold pricing, futures markets, and whether extreme price targets are realistic in a crisis scenario. Now, let us go deeper into one of the biggest questions investors are asking right now. Can gold reach extremely high prices in a short period of time? You often hear numbers like $10,000, $15,000, even $20,000 per ounce. Some people say big institutions are betting on it through futures contracts. Others say it is impossible. The truth, as always, sits in understanding how the pricing mechanism actually works. First, we need to understand the difference between spot price, futures price, and physical reality. The spot price of gold is what you see quoted on financial media platforms. But that price is heavily influenced by futures contracts traded on large exchanges. A futures contract is simply an agreement to buy or sell gold at a future date for a specific price. Most of these contracts never result in physical delivery. They are closed out or settled in cash before expiration. This is important. When you look at gold's price movement, you are mostly looking at paper contracts changing hands, not physical gold bars moving from vault to vault. That means price discovery is happening in a leveraged paper market. A small amount of margin controls a large amount of gold exposure. This increases volatility and creates the appearance of deep liquidity. But here is the weakness. The system works smoothly as long as most participants accept cash settlement. If too many contract holders suddenly demand physical delivery, stress begins to show. The exchange rules allow cash settlement precisely because there is not enough physical metal to meet all paper claims at once. This is not a conspiracy theory. It is simply the mathematics of leverage. Now let us talk about those big price targets. Could gold reach $15,000 or $20,000 per ounce? Technically, yes. Any price is possible in a fiat currency system because fiat currency supply can expand without limit. But such a move in a short period would likely require a serious financial crisis. It would not happen just because traders feel optimistic. It would require a loss of confidence in currency, debt markets, or the banking system. Remember the pyramid structure we discussed earlier. At the top sit derivatives and complex financial contracts. Below that sit bonds and equities. Below that sit bank deposits and currency. And at the very base sit physical gold and silver. If stress appears at the top layers, it slowly moves downward. Investors start questioning counterparty risk. They move from risky assets to safer assets. Eventually, they look for assets with no counterparty risk at all. That is when gold and silver move aggressively, not because they changed, but because trust in paper claims weakens. Now let us talk about fundamental value. How do we estimate what gold is truly worth? One simple method is to use government debt as a proxy for currency creation. When governments run persistent deficits, they issue debt. Central banks often monetize part of that debt by creating new money. Over time, total debt reflects the expansion of currency units in the system. If you divide total sovereign debt by official gold reserves, you can estimate a theoretical gold price needed to back that debt with gold. When analysts perform this calculation using current global numbers, the result can be dramatically higher than today's spot price. Even conservative calculations often produce figures in the tens of thousands per ounce. If you narrow the focus to one country and assume a partial gold backing of its currency, the implied gold price becomes even higher. This does not mean markets will instantly jump there. Markets move in stages, but it shows that compared to debt expansion, gold's current price may still be undervalued from a monetary perspective. Another important concept is purchasing power. Fiat currency gradually loses purchasing power over time. That is not an opinion. It is visible in long-term data. The purchasing power of a currency declines as money supply increases faster than goods and services. Gold, on the other hand, has historically preserved purchasing power over long periods. It fluctuates in the short term, but over decades it tends to maintain real value. So when someone asks whether futures markets can predict gold's future price, the answer is limited. Futures markets can show trader sentiment and short-term positioning. If many traders are buying contracts, it suggests expectations of higher prices. But futures markets cannot predict systemic crises. They react to them. If a real liquidity crisis emerges in derivatives or bond markets, gold's move could be sharp and fast. But it would not be because of technical indicators alone. It would be because trust in the financial structure is breaking. We must also be realistic. Markets rarely move in straight lines. Even in strong bull markets, gold experiences corrections and volatility. Large institutions often use futures to hedge positions or manage risk. That can temporarily suppress price spikes or create rapid pullbacks. But long-term trends are driven by macro fundamentals: debt growth, currency debasement, and confidence levels. In simple terms, gold does not need to do anything dramatic to prove its value. It simply needs the currency to continue losing value. If money supply keeps expanding and debt keeps rising, the revaluation of gold becomes a mathematical adjustment rather than a speculative dream. Now let us bring everything together in a practical way. We have talked about liquidity. We have talked about derivatives. We have talked about debt, currency debasement, and the structure of the financial pyramid. But the most important question is simple. What does this mean for you as an investor? First, understand this clearly. The financial system today is built on leverage. It is built on promises. It is built on contracts that depend on counterparties. As long as confidence remains strong, the system appears stable. Prices move up and down. Markets function. Banks operate normally. But when confidence breaks, the unwind can be fast and aggressive. Liquidity disappears exactly when people need it most. In a highly leveraged system, small problems can create large consequences. If a derivative counterparty fails, the loss does not stay isolated. It spreads through interconnected balance sheets. Banks owe money to other banks. Funds owe money to banks. Corporations depend on credit lines. Everything is linked. This is why systemic crises feel sudden. For years, risks build quietly. Then one trigger exposes the weakness. Now think about gold and silver in that context. Physical gold and physical silver have no counterparty risk. They are not someone else's liability. They are not dependent on a bank staying solvent. They are not dependent on a derivatives exchange functioning normally. They are tangible monetary assets. This is why they sit at the base of the financial pyramid. When stress moves down the pyramid, capital flows towards safety. First, investors move from risky assets to government bonds. Then, if trust in government debt weakens, they move toward hard assets. That is when gold and silver tend to reprice dramatically, not slowly, not politely, but aggressively. Many people focus only on spot price. They check it daily. They celebrate small moves or panic over small corrections. But the real story is purchasing power. If currency continues losing purchasing power, gold does not need to skyrocket to be valuable. It only needs to hold its value while fiat money declines. Over time, that difference becomes powerful. When analysts calculate the fundamental value of gold by comparing total debt to official gold reserves, the numbers often look shocking. Tens of thousands per ounce is not a fantasy number under certain monetary models. It is a mathematical reflection of how much currency has been created relative to how much gold exists. Whether markets move there quickly or slowly depends on confidence in the system. Could there be an overnight revaluation in a crisis? Historically, yes. Governments have reset currencies before. They have revalued gold before. During extreme inflation or monetary reform, assets can be repriced rapidly to stabilize balance sheets. But these events usually follow severe economic pain. They are not smooth transitions. They are responses to instability. This is why preparation matters more than prediction. Trying to guess the exact month or year of a major reset is nearly impossible. But understanding structural risk allows you to position yourself wisely. Owning physical gold and silver is not about getting rich overnight. It is about protecting purchasing power across uncertain cycles. Also remember, diversification matters. No single asset solves every problem. But ignoring monetary history can be dangerous. Every fiat currency in history has eventually lost most or all of its value. Some collapsed quickly, others declined slowly. The pattern is consistent. Debt grows faster than real economic output. Money supply expands, purchasing power erodes. In that environment, holding a portion of wealth outside the banking and derivative system can provide stability. Physical metals do not generate yield. They do not pay dividends, but they preserve value when paper promises struggle. As you move forward, focus on fundamentals. Watch debt levels. Watch money supply growth. Watch signs of liquidity stress in credit markets. These indicators matter more than daily headlines. The system works until it does not. And when it does not, those at the base of the pyramid stand stronger than those at the top. If you found this analysis valuable and you want deeper breakdowns on gold, silver, debt markets, and global liquidity, make sure you subscribe to Gold Silver Scope and stay connected. We focus on clear, simple analysis that helps you understand the bigger picture without noise or hype.